Hi, Jewel. Justin, how are you?
Hi, how are you?
Good, good, good. Let's uh let's wait for a few more of your classmates to join us and we can get started. What I want to do today is to kind of go through the midterm exam. I'm going to call on individuals who got the questions correct to explain why they made that choice. And we'll soon find out if you were lucky or if you were good.
Uh, okay.
You know what they say, it's better be lucky than good, but I'm not sure. Over the course of a 50 question exam, you can get lucky for a while, but the good ones will come out in the end. And the good thing is, I'm glad to report that most of you did very well. A few of you could use a little improvement, but I wouldn't say that there's anything there that's really major. And even the people that didn't do great um, didn't do terribly. In other words, there was nobody who failed the exam. Everybody passed the exam. Question is, at what level did you pass it? But anyway, I thought that'd just be a kind of a fun way to spend this session would be to go through the each of the 50 questions. I'll call out on somebody that did get the question correct. Um, and we'll let them explain why. But yeah, let's see who else. It looks like we got Karen in here now. Great. Hi, Karen. How are you?
Hi, I'm fine. How are you?
Good. Thank you for asking. I'm doing great. Okay, so there's just the four of us so far. Yeah, I had my meeting with my other group. Dylan just joined us. He's in that class that I'm also teaching this term, the 470 course. And we had that session earlier today. I get kind of talked out from these things, so that's why I think I'm gonna kick the ball over to students that got each of these questions correct and let them do a little talking. So I'll do that in a moment. Looks like we got Dylan, we got Karen, we got Jewel, we got Justin. And it's now coming up on 3:30, so hopefully we'll have a few more of you join us. Fabian's joined us. Great, Fabian. How are you doing? Good.
I'm doing good, good. How are you?
Great. Yeah, I'm fine. Thanks. I was just explaining to everybody else that got here just a bit earlier that I'm going to ask students that got individual questions correct on the midterm to kind of take the lead. I'll call on you. I got all my little cheat sheets right here on who did what, and you can explain why you made your choice, either the multiple choice or when we get down to the true and false questions, and explain why you made those choices.
Cool.
Let's see here. Okay, a few more people are joining us. Brazil has joined us. Hi, Brazil.
Hi.
Let's see if you. Oh, great. Aaron's here. Hi, Aaron.
Hello, hello.
Okay, I think we got a quorum. It's now just after 3:30, so we can say we've officially started the meeting. I'm going to minimize out of my my participants box. Yeah, it looks like I want to get back into it for a moment here. Tyler's joined us. Good. Okay. How you doing, Tyler?
Doing pretty good. How about you?
I'm doing well, thanks. Let's see. Okay, I think we can get started. So, as you all know, we had the midterm last week. And I turned it around. I pretty much sat right on that assignment as students got them handed in. I pretty much turned it right around for you because I wanted to get those in the rear view mirror quickly so I could start determining what I'd want to do for this session, which was to actually walk through the problems and have individuals. I thought it'd be good for individuals that got the questions correct. I could call on them and they could explain why they made their correct multiple choice selections or why they were either true or false, also correct. So let's see what we can do here. I'm going to move down the document that I'm sharing now and come to question one. Question one. Looks like you got that one right, Dylan. Dylan Strawley, why did you select the correct answer here? Do you recall what you did with to come up with the right answer on number one? Dylan, you with us? I thought you had joined us. Okay, I guess he's not here. He's not with us. Let me take a quick look here. Okay, Fabian, you got this one right. What did you see in problem number one that you were able to make the right selection? Do you recall how you got that?
Yeah, so I was first trying to figure out the coupon rate, I think it's called.
Yeah,
So
the
I did like the
coupon rate,
30.
yeah.
So I did like because it was a perpetuity, so I did the 31,250. And then if I remember correctly, I took the 2,500 and divided that by the 31,250, which came out at 8%, if I'm not mistaken.
Correct. Yeah.
And then I just did the present value calculation. Basically plug those numbers into the calculator. I don't know, we had this like finance calculator.
Yes.
And I got the present value.
Very good. That's exactly right. It's a two-step problem. You got to find the interest rate on the perpetuity that's going to give 2,500 divided by 8% is going to give you a $31,250 value. So you know that 8% is your required rate of return on a perpetuity. So they go on to say that, okay, well, if you have the same required rate of return, which is once again it's 8%, and you got a 40-year now all of a sudden it turns into a 40-year annuity. So you got the $2,500 each year at 8% for 40 years. You simply find a present value of that, and that's how you get to 29,811.53, which is answer B. So that's exactly right, Fabian. You got that one right. A lot of other students got it right too, so I was glad to see that. But a couple of you did miss it, so hopefully you're taking notes and can understand exactly why we did what we did there and why Fabian did what he did there and got the answer correct. Okay, let's move down to number two. Jewel, it looks like you got number two correct. what did you see in problem number two that gave you the right idea to select the right answer there?
Wait, number two.
Yeah, we're talking about the
Um,
maturity and
I mean,
annualized yield.
that's that's exactly what's in the book. So
That's well, yeah, yeah, I guess so. I mean, that's pretty much it. I did take a lot of these
yeah,
directly from the text as far as wording goes, but yeah, the relationship between term of maturity and annualized yield is referred to as a term structure of interest rates. So yes, you're absolutely correct. It's right out of the text. Answer is C there. So very good. Several of you got that correct. A couple of you didn't though. So hopefully you can go back and maybe find that little word or description in the text if you look up the term structure of interest rates in the index. It'll probably refer you right to the discussion that I took that question from. But yeah, that is definitely the term structure of interest rates, and the answer was C. Okay, thank you there. Let's move on to number three. Lisa, are you with us? Okay. I see Justin's with us. Justin got this one right. What did you see about number three, Justin, and why did you answer correctly?
Um, it just made the most sense to me of all the other definitions. Financial markets. I remember at the very beginning of class talking about with Professor Ding about the kind of the process of the money and transferring from different places, and it just made the most sense to me. Yeah.
No, totally understandable. It does it of all those answers, that one probably does make the most sense. I mean, I tried to come up with some, bogus answers that might seem possible. I didn't want to give the question away, but transferring from bank to bank or from buyers to sellers or creating deficit units, just using some language out of the text. But in the case of C, deficit units is definitely a legitimate term, but financial markets aren't going to create them. Just trying to come up with some some reasonably possible answers, just to potentially throw you guys off from the obvious one, which is in fact D. Then I threw in one of those B and C type only, or two of the answers only to further try to throw you guys off. But not including the correct one, which is obviously D. So yeah, so D was good. Thank you, Justin, for that. Let's move downward here and continue on. Number four. Okay. Marv, are you with us? Let me get back, and so I'm not calling on people that aren't with us today. Okay. Okay, Nina, it looks like you were correct on this question. Do you recall what you did to get the right answer for number four?
Um, Let me just read over the question again.
And when investors receive new information about a security,
mm, well, it has been, well, it's a few days since I've done that, so
that's okay. At least you did get the question correct. Fabian, you got this one right. What did you have to think about,
oh,
or did you want to carry on, Nina?
well, I've thought about if that security has higher cash flows and less uncertainty. I kind of I didn't go with A because of the immediately in that sentence.
Right,
Because I was like, okay, they probably won't go with it immediately without thinking about it first. So I kind of, yeah, I didn't choose A because of that.
right.
Um, and I didn't think they would invest into other securities, so it could not be D and E, because it is kind of a good security in that sense, if it got
Yep.
higher cash flows and less uncertainty. Um, and I would say, so for me, B made the most sense because they would probably want to invest in it pretty soonish before the cash flows and uncertainty values change again. That's why I think they would not wait like an answer C and they would choose B and maybe reevaluate what they thought about the security before.
Yeah, good. I think I like your logic there. I think that was a good way to look at the problem. You do see that a securities indicating higher cash flows are going to happen pretty soon. There's less uncertainty. So those are all, as you said, as you pointed out, favorable things for that security. So you know that, okay, well, it's positive news. So what is positive news? What does that mean? And I liked your thought too on the idea of the of discounting A, in other words, or not accepting A, because of the immediately word there. And I put that in on purpose to try to mislead people. You know, okay, well, you know, you see that this is good news for the security, you know, jump on it, buy it right now, no matter what. Well, no, not necessarily. That's a possibility, and you might end up being okay, but you know, usually you don't want to just do, you know, make knee-jerk reactions to, you know, good news or even bad news, you know, sell things right away because you're worried about how they're going to do long term. You know, you hear bad news. I mean, you hear good news, you hear bad news about securities. You know, the best thing to do is to not overreact. So good there. And yeah, waiting on these things to, you know, for a yield curve to flatten. That's got absolutely nothing to do with it. And I just threw that in there out of left field. And other securities, you know, purchasing or investing in other securities, that's kind of out of left field too. So yeah, you're right. C and D you could get rid of right away. A is kind of a misleading statement, which probably would be too wise. So really the answer ends up being B. You were right. And I think you were right for the correct reason. So good job there. Thank you. Okay, let's move down to number 5. Um, okay, I gotta keep going back to my participants list to see who's joined us and to see who got this one correct. Looks like okay. Brazil, you got this one correct. When it comes to number 5, interest rate movements, then you're given a bunch of different answers. You got this one correct. What did you see in number 5, Brazil, that led you to choose the correct answer?
I kind of just did the process of elimination. I went through them and just kind of see what's the best fit because they do have a direct influence on the market values.
Right.
Like I would go through A are relatively unimportant when making investment decisions. That's not true.
Right.
So, like I just did kind of the process of elimination and thought C was the best option.
Yeah, no, absolutely. I like that logic too. I mean, you know, you obviously have some selections here. You can eliminate the ones that don't make any sense right away, and then kind of focus your thoughts on what might be the correct answer after you eliminate those bogus ones right off the bat. So yeah, A, no, not at all. B, well, you know, likely to affect real estate more than bond. Yeah, what? No. You can get rid of A and B pretty much right off the bat, like you were saying, and then loanable funds will lose value. What? Nah, you're right. I think you can eliminate, these bogus answers pretty quickly and kind of focus in on what the correct answer really is. So yeah, you're absolutely right. Interest rates do have a direct influence on market values of debt securities like bonds and also money markets. And I believe the statement is right out of the text. So that's one that I found that I don't think was on a quiz, but it was right out of the textbook. So good. Thank you for that. Very good. Let's see what else I got here. Number 6 we're coming to. Okay. Let's take a quick look. Okay, Aaron, it looks like you got number 6 right. What do you think about number 6? What did you see there about bond prices and interest rates?
Yeah, I think we already talked about this one in class, either with you or Dr. Ding, or I think possibly both. Yeah, it's pretty, I think, well known that bond prices and interest rates have an inverse relationship. And that's how you kind of get the ideas of bonds being sold at discounts and premiums to kind of reverse that inverse relationship of, when a interest rate goes up, the base value of the bond stays the same, so that its value, inherent value, decreases or increases accordingly. And yeah, that's how I kind of got that answer. That was a quick one for me.
Yeah, good. Yeah. I saw that a lot of the students did get number 6 correct, but yeah, that's absolutely right. I know we did discuss that. You probably did also discuss it with Dr. Ding. And the thing at the end of the day, you got to realize that bond prices, you got to always remember bond prices and bond valuation is just a question of present value calculations, right? So if you're looking at a present value situation, the higher the interest rate that you're discounting these future cash flows by, right? The higher the rate, the lower the present value is going to be, the lower the bond price is going to be. Correct? Because we're discounting all your future cash flows, the coupon payments, and certainly then the face value of the bond, which matures at the end of the term of the bond. All those will be being discounted at a greater rate. So you'll have a lower bond value the higher that discount rate is. So that's one way to look at it as well, and the correct way when you actually get into the detail, the calculations of valuing bonds. So yeah, so 6 is A. Thank you for that, Aaron. And let's move on to number 7. Okay, so we're kind of in our little bond mode here. We got a couple bond questions all right here in a row. Number 7. Let's see who's here. Who got that one right? Okay. Connor got that one, but he's not with us. I don't see him. Okay, Dylan. Looks like you nailed this one. What do you think about number 7?
Yeah, number 6.
I'm
So
sorry,
I
number
said
7.
A, and I said this because when interest rates go up, bond prices are going to go down, and that's based off of that's based off of the government releasing more bonds, and when they take away bonds, and when they do this, interest rates are going to go up. Or wait, I'm thinking about it backwards. So when they release more bonds, the bond prices go down and the interest rates go up. And then when they take bonds away, the bond price is going to go up and the interest rate is going to go down. And so
Okay,
I kind of just remembered that from like economics back in the day.
okay, well, that's a true statement. I'm asking specifically about number 7 though at this point. So we're looking at a $1,000 face bond that's selling for 980. So what does
Oh, I
that
said it
mean?
was selling at a discount because it's
Oh, right.
selling less than its face value.
Yeah, that's exactly right. It is selling at a discount, but I did throw in a couple, bogus, misleading types of answers that might have a little small sense of logic to them that might, cause people to think a little bit like, okay, well, maybe a bond that's selling for 980 is losing money. Well, no, no, it might have an interest rate or required rate of return that's lower than the coupon rate. I don't say anything about the coupon rates in this thing, but if a coupon rate, um, if a required rate of return is greater than the coupon value or the coupon rate that a bond is paying, then that bond is going to be selling for less than its face value, right? Does that make sense to everybody? Make sense? You're not
Yeah, it
your
makes sense.
required rate of return is greater than what you're getting in cash flows. So that bond is going to be worth less than its face until the required rate of return changes. If it becomes equal to the coupon rate, then it's gonna sell for the face value. And if the required rate of return ends up becoming less than the coupon rate, then the bond's gonna be paying more than your required return over the periodic coupon payments. So it'll be valued for more than the face, right? But yeah, and what a bond is selling for less than face value, it's literally selling at a discount. So thanks, Dylan. That's exactly right. Let's move on to number 8.
Real quick on that one, I was just curious too. So for me, the process of elimination on that was the fact that the book talks about discounts. It doesn't talk about selling at a premium. It doesn't talk about losing money, anything having to do with those within that specific thing. Because technically, the way that I saw it, because it doesn't have coupon rate, it doesn't have any other information other than that it's $1,000 bond selling for 980. So with that information, yeah, it is losing money because the person who bought the bond before at $1,000 is now selling it for 980, so therefore they lost money. Selling at a premium, I mean, it would be a premium for the buyer, so like going through there, I did notice that like there's a justification based off the information that was given there. The only thing that caught me for it was that the book discussed discounts. So that's where I made that, because for me, I like to I end up tricking myself into thinking other answers, and so that's why I had to like break it down and try to make sure like, okay, I mean, it is losing money, but we didn't talk about losing money. We talked about discounts when it came to bonds. So
Yeah, thank you for that, Justin. I think that's a good piece of thinking. You do want to look at each option and either argue for it or against it. What makes sense, and that's the losing money idea does I put that in there for a reason. I want, and I got to admit, several of you did make that choice, and it isn't really the correct one because I could have worded this problem a little bit better, maybe by saying that a bond with a $1,000 face value that is currently priced at 980 instead of saying selling, because when you say selling, you are inferring that that investors are divesting themselves of that security. They're actually making the transaction to sell it. And if they do sell it for 980, then they will be losing money. If provided they bought that original security, that original bond at face value. But I don't say any of that. I don't say, you could have bought the bond for, $1,200 if interest rates had been really low, after this bond had been issued. You could have bought it for 1,150. You could have bought it for 600. if rates, really dropped, after the issuance at some point. So I don't say any of that. So there's really not, enough information to know for sure if you're losing money on the deal. You certainly know it's not B. The bond isn't selling for a premium, and you should also know that D doesn't make any sense. Should be purchased in all cases. No, not necessarily. Even if it's currently, valued only at 980, it still might not be hitting the required rate of return that you have personally, or that your portfolio has overall, or you might not want it to be in your investment portfolio for a number of different reasons. So you can't say D either. So, I think, continuing on with your thought of eliminating, the ones that don't make sense, going through the process of elimination. I think you can, safely eliminate most of them, and then you're kind of stuck with A and with C. And I don't think you have enough real information there to choose A. So the answer becomes C. So thanks again, Justin, for that. All right, let's move on to number 8. Bonds are, I just referred to this whole idea, but does anybody want to just pipe up and talk about 8 and why they got it right? I'm not going to call on anyone specifically this time. Who wants to take the ball on number 8?
For me, that was just kind of a process of elimination question too, because present value techniques is pretty much what we've been doing to value stuff. So
Yeah, thank you, Tyler. I think that's absolutely correct. That's a good answer. I mean, at the end of the day, random walk theory doesn't have anything to do with bond valuation, not really. Um, Economic value techniques, that's something entirely different when you're finding the EVN of a company, not the EV of a bond. Salvage value's got zero to do with bonds. Face value is, and I made up that term. I don't think that even exists. So yeah, present value techniques are how bonds are valued. Once again, you're discounting future cash flows to a current point in time, or at a given point in time, to understand what the value of a future stream of cash flows is going to be at either at today's date for the present value, or at some other date and time. But you always present value future cash flows to that point in time. So yeah, very good. So we got that's the correct answer for 8 is E. Okay. Fundamental analysis is what? You got a couple different options there. Who wants to chat about number 9?
9 should be B. Well, I mean, we discussed this in class. I think that fundamental analysis, you're looking at the fundamentals of a company, so you're looking at the financial statement, pretty much. Well, less reliable than technical analysis can be, but most likely is not true. It is often used by professional analysts, often used by the investing public, and I think A is also not true. So
Yeah,
B.
is more reliable when markets are inefficient. For what reason? I just made that up. That's not correct, obviously. Yeah, less reliable than technical. It can be, depending on who's doing the technical analysis, and what instruments are being analyzed. I mean, there's situations where technical analysis may be more reliable than fundamental analysis, but you can't make that any kind of a blanket statement. And these are, I'm looking for a blanket statement here. I have no specifics or caveats indicated. Fundamental analysis is what? Well, at the end of the day, it is, yes, correct, based on a company's financial statements. That is the nature of fundamental analysis, and that's how it's done by looking at current financial statements, historical financial statements, how a company is actually operating and how its results are stacking up, not only on a trend line but also compared to other um, you know competitors in the same industry or similar types of companies. So yeah, so the answer is definitely B. Okay, let's move on to 10. In normal economies, you've got um, a certain situation with term and with interest rates. And I'm just going to take the ball on this one because basically we discuss yield curves and what those mean. If you got um, an increasing line on a yield curve, if the slope of that yield curve is moving upward, that means you've got term right on the horizontal axis, and on the vertical axis you got interest rate. So a normal economy has a gradually sloping yield curve. So that means that as term increases, going left to right on a graph, on a bar chart, you got a situation where that interest rate is rising. So yeah, and that makes sense. I mean, if you are going to hold on to a security for an extended period of time, you would expect to have a higher interest rate, right? That's part of the basic interest rate and risk trade-off. The longer you hold an investment, the riskier it is that it may eventually lose money for you. So the longer the term, the more return you need to have, and that translates to a sloping upward of a yield curve, and that's in normal economies. Okay, let's move on to 11. We've got which of the following types of information will most likely enable the exploitation of a profit opportunity? And this is, yeah, I gotta admit that some of you missed out on this one. Let's see what we got here. Tyler, it looks like you got this one. You're up again. What made you pick the right answer here, which turns out to be E?
A through D kind of just seem like they violate the market efficiency hypothesis.
Yep.
Saying that you shouldn't be able to make abnormally high profits based on like analysis like that. So
Right.
it only makes sense that if you have insider information that nobody else has, then you could consistently make higher profits.
Good. Yeah, I agree. I think that's a good answer. I think can't remember exactly what my sources were for each one of these problems, but as I recall, this was a rewording of one of the quiz questions where I think one of the quiz questions was talking about insider information and how that's really the only because it's potentially illegal, why it's the only means whereby a person could really exploit a profit opportunity would be through insider information. And it's as I recall, that was a quiz question that I just kind of jumbled around and turned into a multiple choice question. But yeah, I think that's a good answer. You can eliminate A through D, when you start thinking about efficient markets and how they generally prohibit um, exploitation of opportunities. It doesn't allow for too many profit opportunities to just present themselves. But yep, that good old insider information could be the old the means whereby people can beat the market, but they got to watch themselves if they're company executives and stuff, if they're trading based on their own company's knowledge and their specific knowledge or insider knowledge of of that company. They got to watch themselves. So yeah, thank you for that. That's absolutely correct. All right, continuing on here. As I recall, this is right out of the text too. So anybody want to talk about buy and hold strategy and what that might mean?
I can. Um, yeah, it's basically you, what it says, you buy a stock or asset or whatever, and you hold it for, I guess, as long as you can until you're, you know, until something happens. But the idea and reasoning behind A is because of like ideas behind, broker commissions, other fees associated with people you go through to buy these at stocks or bonds or whatever. And generally speaking, if you buy and hold one asset, your net profits will be higher than if you were trying to continuously flip assets as they go up and down over time.
Yeah, I like that, Aaron. I think that's a good way to put it. I mean, you could make an argument for B and say, well, losses will eventually be eliminated depending on how long you hold. But not necessarily. A company could uh, could begin to lose money for you in an investment, and then eventually, go bankrupt and you're stuck. You're SOL. You lose, and there's no opportunity for that investment to turn around and eventually make money. So you can't really say losses will eventually be eliminated. The others, that don't really, the longer a stock is held, the higher its price will be. What? Boy, that's a no. That's a definite no. So yeah, I think you can eliminate the others very quickly. But if you look at A, that's really going to make logical sense to when you're buying and holding, you're just not engaged in a lot of market activities, so you're not going to have a lot of brokerage commission fees. You're making fewer transactions when you buy and hold. So I think it's logical to say, okay, well, if I'm not making a lot of transactions, then I'm not going to have a lot of brokerage fees, and I'm going to cut a lot of those out of my the process that I'm using to construct my portfolio and my investments. So yeah, so 12 is A. Okay, on 13 we've got the efficient market hypothesis suggests. Well, what does it really suggest to? Does anybody want to take number 13 here and explain why they think they got that one right with the selection of D, that they're all the above are sensible strategies here? You got this one right, Fabian. What made you choose? I know you're such a proponent of efficient markets.
I just think that information is not distributed equally, so or access to information more to speak.
Well,
Um,
you all know that I agree with that comment. I don't really believe in efficient markets. I think that a lot of investors are lazy and don't do their homework. But I also know that we have things like the internet and so forth that do make sharing information much easier than in the past. But yeah, but seriously, why did you think that A, B, and C were all possibilities there? What did you see that led you to make the choice of D?
so from what I personally know is that if you just buy the broader market, on average, you make a greater return than if you were constantly trading.
Right.
So that is A, basically.
Right.
Then B is pretty much the same thing. You just buy and hold the broader market and you make greater return.
Right.
And then C, if you don't have a lot of money, you can just buy in the mutual fund, which might be actively managed. So they do basically all the work for you. And so I would say that all of the above are the sensible strategies. and then E kind of is playing itself out of the race, so to speak, because that would only be 2 instead of all the 3.
Yeah, I threw that in there at the very end, and instead of having none of the above, I wanted to take 2 of the correct answers, but only 2 of them. And I got to say that I did mislead a few of you with that selection. A few of you did take E, and I feel a little bit bad about that. But at the end of the day, you got to remember that C is an obvious choice. I mean, you can always read about mutual funds being a sensible strategy, especially for beginning investors or smaller investors that, as you say, even if they're not actively managed, even if they're just passively managed, you still have, um, a diverse, usually diverse set of companies that these funds are invested in. So you got your diversification is done for you when you choose mutual funds, or at least a lot of mutual funds have a good diversity mix to them, whether it be within industries or size of companies or just general index related funds that cover an entire index. You've got a lot of diversity there. So C is definitely a correct option there. And as you mentioned, A and B are very good selections too. If you stop and think about those a little bit. So yeah, definitely A, B, and C, which leads to the answer being D, which is all of those above strategies being sensible. So good, great. Okay, let's move on here. We've got number 14, which I like this. I like this question. I thought it was pretty cool. So you got a phenomenon that's observed when a company stock falls, but the announcement was generally favorable. What might that be? Okay. What do you think? So you got, I'm going to take the ball on this one. Several of you did get this correct though, so I could call on a number of you. But yeah, if you're looking at this question, you got to say, okay, well, what really makes sense here? Is this phenomenon? Well, it's clearly inconsistent with the efficient market hypothesis. Well, no, not really. The efficient market hypothesis generally states that, all information is essentially out there for investors to take advantage of. There's no real profit opportunities that are going to present themselves, at least over a long period of time. Uh, so that doesn't really have anything to do with the fact that a company's price uh, might fall despite the announcement of favorable earnings. You got to stop and think about what's really going to make sense. And the more you look at it, the more you can see that, well, B makes the most sense because you're talking about it's consistent with the efficient market hypothesis, but only if the earnings that were announced, right, were as high as anticipated. I mean, in other words, if market expectations are not met for a company, you know, uh, then people are going to, be disappointed by that. They're going to either sell that, they're not getting as high a return, or the company's not doing as well as they think that it should be, and it's all involved with market expectations, which play, just an incredibly important role in any company's stock value. Okay, so yeah, so definitely B is the correct answer. I'm glad several of you got that correct, but yeah, definitely B. Okay, let's move on. We got what was it? We just lost my place. Yeah, okay, number 15 we're looking at here. Okay, I'm going to call on Brazil. What do you think? I'm kind of talked out here a little bit after that last question. On 15, Brazil, what made you select D for the correct answer? Are you with us? Just step away. Okay, let's see. Down here and see who else is with us. Okay, Tyler, you've been a fountain of information today. You got this one right. What
Yeah.
what did you see in 15?
Um, well, first of all, I knew that A was correct because I remember that being one of the options in the multiple choice like quizzes that we've had in the past. You know, the market is pretty much just unpredictable.
Right.
But then I also got the previous question right. So I knew that C was also correct. Or I was going off the assumption that C was correct.
Right.
So I knew that it couldn't be E because I knew that C was correct too. So that's what led me to D, thinking that all of them were correct.
Okay. Yeah, and I think at the end of the day, you got to look at what, efficient markets really are again. And B, you didn't talk specifically about B, but stock prices, will respond to announcements only when the information in these announcements is new. Well, that pretty much is true because if you have old news, then that's already factored into a stock's price, right? So in other words, it's not really going to respond to that old news. So, stocks responding to new news is kind of part of the general efficient market hypothesis, right? Makes sense. So anyway, yeah, you're right. I mean, that was a good approach um, to eliminate what did make sense, and you're definitely sitting there with all of the above being the right answer. So A, B, and C are all options that are correct that make sense. Okay, great. So let's continue on here. We got number 16. Although the verdict is not yet in, the available evidence indicates that for many purposes, the efficient market hypothesis is what? Who wants to take the tiger by the tail and come out with the answer on this one? I don't know, Justin, you got this one right. What do you think?
Um, Trying to remember my thought process on it.
It's fair enough. Um, but yeah, I think, generally speaking, that might be a comment right out of the text. It's a good starting point. Okay.
Yeah.
Well,
I mean, it's a good, I don't know, I guess it's very straightforward and simple if to be like, yeah, like, the hypothesis would be a great starting point for analyzing your expectations. Yeah, I don't remember exactly how I thought this one through, honestly.
yeah, no, not like I said, that's fair enough. It's if you stop and think about it, it's a fairly straightforward question. I mean, it's if I remember correctly, this is another phrase or another statement right out of the text. I mean, I saw that it was a good place to start, okay, and that then I started trying to come up with some bogus answers that might at least seem reasonable. So I started to get into real specific situations where it might not be a good starting point for analyzing expectations. Well, no, too general to be useful for analyzing expectations. Well, it I don't know. I might argue that C could potentially be a correct answer too, but not more not more so than A. Yeah, I mean, if you stop and think about it, um, the efficient market hypothesis is a good starting point. It's not the be all and end all for analyzing expectations or for even understanding expectations, but I think it's a good place to start. So, based on that, based on the comments in the text and the fact that it was right out of the text, let's move on and leave the answer as A there. Okay, so we got 17. The efficient market hypothesis. I did tell you there was going to be some efficient market hypothesis on this test, didn't I? Anyway, the efficient market hypothesis suggests what? Does it, you got options A through C, then you got A and B only are sensible, then E says none of the above. Who wants to talk about this since we've been chatting about efficient markets now? What do you guys think? Anybody?
A just made the most sense to me on that one. And also B and C just, I don't know, they just really just didn't seem right.
Yeah.
I mean,
Tyler.
obviously B isn't right, but then like C isn't right either because, we've already established that it's when you are constantly buying and selling securities, you're gonna rack up those fees associated with those. So yeah, C didn't really make sense either. So A just made the most sense.
Yeah, no, I agree. That's once again, when I created this exam, I was just reading through the text, and when I saw a good statement made in the text, I'd turn it into a question. So literally, I'm sure the text said somewhere that the efficient market hypothesis suggests that investors should purchase no load mutual funds which have low management fees. It probably said that word for word, and then I just created B, C, and then jumbled around with D and E options, to round out the question. But yeah, I think that they talk about, no load mutual funds, just like we kind of referred to that earlier question um, about buying and holding, and why transaction fees, on mutual funds, which are obviously very similar to loaded mutual funds, are going to cost you money, or why no load or low transaction fees are going to help you make money in an efficient market because you're buying and holding, you're not trading so actively, so you're not incurring those transaction fees. So yeah, so the same thing goes for loaded funds. So you kind of turn that around, and you can change that into why purchasing a no load mutual fund is going to be a advantageous situation to exploit, if you believe in efficient markets. So yeah, so A is definitely the right answer there. So very good. Let's move on here. We got 18 talking about efficient markets. Once again, we got efficient market hypothesis that applies to what? I'm just going to jump in on this one and answer it. Both the stock market and the foreign exchange market. I remember that one specifically was right out of the text. I think it was right out of a quiz question too. Um, but then I started playing around with it. I said, okay, well, let's vary it up and say, well, it's the stock market, but not the FX market. The FX market, but not the stock market. The stock market, but not the foreign exchange, or neither of them. And then, that it refers to the bond market. Yeah, I tried to come up with all those other answers to throw you guys off, but most of you did get this one right. And it is right out of the text that the efficient market hypothesis does specifically apply to the stock market and the FX market. So that makes A the right one. Okay, I'm going to continue on here. 19, we got the answer is A, and that's another one that's right out of the text. They talk about the January effect, and in something called the January effect, stock prices experience an abnormal rise from December to January. That's another one that's right out of the text. And I would guess I don't recall it saying specifically why. Maybe I missed that, or maybe I'm not thinking of it right now. But I would guess it has, something to do with the holidays, the holiday season. A lot of stocks do perform very well during the holidays, and that's because a lot of stock prices are affected by increased sales experienced by those companies or those companies' products. A lot of people are on purchasing binges around the holiday season, whether it's for themselves or gifts for family and friends, that sort of thing. But yeah, the January effect, stock prices experience abnormal price rises from December to January. And most of you got that correct as well. All right. Number 20. Small firm effect refers to observations that small firm stocks do what? Okay. Hey, Fabian, you got this one right. What do you think?
I chose C just from like basic market understanding. If you compare the small cap to like the large cap broader market kind of, I don't know, mutual funds, whatever indexes, over the last like 20 to 30 years, I guess, the small cap index has outperformed the large cap index by a lot. Even though like smaller companies have a risk associated to them, which is much larger than like the larger companies and like the blue chips.
Right. Yeah. As I recall, there were some different graphics in the text that showed, performance of, larger companies, small caps, etc. And I think one of the captions that went along with the small caps was that the companies might have had experienced a little bit of higher risk, but then according to risk and return trade-off, I mean, if companies are a little bit riskier, they usually have the higher returns. So yeah, so good. That was a good answer. I mean, you are correct. The small firm effect refers to the fact that smaller firms have typically experienced higher returns. Okay, and they do, even though they do have greater risk. That's been a known fact. Okay. 21 in recent years. That was right out of a quiz. I was getting a little bit lazy at that point. I took one of the quiz questions. But stock markets have crashed. Fabian, as I recall, you had asked about the time frame of what recent years really included, but I think I referred back to you in an announcement that I made to everybody that it was a quiz question and it was probably related to something over the last 50 years or so, if I remember right. But yeah, I mean, there have been a few instances over the last 40, 50 years when stock markets have crashed. I don't think the bond market has ever crashed ever. The success of financial institutions has reached levels unprecedented. Um, I, I don't think you can safely make a statement like that. Interest rates will remain constant. That's a pile of crap. There's no way that interest rates will remain constant. That's for sure. So you can eliminate A and B pretty much right away. D, okay, and then obviously if you've eliminated all these others, E can't be. So you're pretty much left with the fact that the stock markets have crashed, and they have, on a couple different occasions over the last 40, 50 some odd years. That's happened. So that's the answer there. Okay. This one, number 22. Number 22 was a quiz question, but I threw in one option that was going to make the answer to the quiz question different. This turns into a present value problem or a rate. It's actually a rate problem, but you've got a $1,000 face bond or security, so you know what the future value is, right? It's 1,000. What it's selling for is your present value, right? And you got to assume that the term is going to be the same for all of these. Though I do not state that specifically, but that's kind of a foregone conclusion. But yeah, this one, if you do the rate calculations for each one of these, you're going to come up with, a rate, okay, the highest rate being for C, okay, which of the following, 1,000 face value securities has the highest yield, okay? So you're once again you're finding the rate, the yield to maturity is a rate calculation. You're given those other unknowns are given. So the only really unknown is what is the rate. So you do a rate calculation for each of those, and you're going to come up with C. And I'm sorry I misled a few of you folks with that one, but I wanted to see if you were on the stick enough to realize that was just a rate problem that you could do either on a calculator or within Excel, given all those different those inputs that would give you an answer to C as C. I don't think I have that calculated anywhere, but trust me, C is the right answer for that one. So yeah, I threw that one in there to be a thorn in everybody's side, and it ended up being just that for many of you anyway. Okay, let's move on to 23, which is kind of the reciprocal of that. Once again, you gotta find a yield. You got to do a rate calculation, and here you're gonna say, okay, well, which is going to give us the lowest yield? So once again, I think I either took the quiz question or I reworded it differently, and you got a new option in there, which is a 7% coupon bond. Okay, so you know what you know the coupon payments are 70. I don't say anything about semi-annual periods or anything, so you got to assume it's a year. So you got $70 in payment, coupon payment every year for option B. You got a future value of 1,100. I'm sorry, you got a present value rather of 1,100. You got a future value of the 1,000 face, and you can assume once again that the term on all these is the same. But if you throw those into a calculator, and let's say you use a 5-year maturity for each of the options A through E, you would end up with the lowest yield on a 7% bond, selling for $1,100. So once again, these are all just variations of time value of money problems. In this case, you're calculating a rate, and a few of you, I look down the line, I see several of you missed number 23. It was a tough one. Jewel, you were right on the stick on that one. Did you happen to remember the solution of that, or were you lucky instead of being good in this one?
Number 23.
Yeah, number
23.
23. You remember that
Oh,
one?
I just calculated it in Excel. It was B.
Yeah.
I can pull up the file if you
Yeah, if you
want
can, real
to.
quick, great.
I think it was A was 5%, B was -3%, C 15%, 28%, and 18%. And then I just selected the
Okay. So-
the
so-
lowest one.
so you
Yeah.
actually, did you, what sort of a term did you associate with all these? Because I didn't say anything about that.
Oh, I just did, I think I just did a year.
Okay,
Yeah,
do a year, you could do 5 years, whatever. But yeah,
yeah,
yeah, good. Okay, so you were right on the stick. I mean, realizing that you could solve these by, working through Excel based solution, or a financially calculator, handheld calculator, you could do the same thing. But yeah, I mean that's essentially what you got to do, is to punch these values into a spreadsheet or into a calculator to see what kind of rates you're going to get for these different options. So good, very good, way to go. All right. Okay, number 24. We're really beating on the efficient market hypothesis and efficient market theory, but another way to state it, in reading through those, I think you can come up fairly quickly with B, that unexploited profit opportunities will not last. They or at least not exist for very long, as market participants will act quickly to eliminate them or take advantage of them until they no longer exist, until those the prices of the securities adjust themselves and they're valued correctly in the market. In other words, I mean, that's what one of the ideas of efficient markets is, that all information is out there and available. So if you take that as a 100% truth or truism, then you're not going to have any unexploited opportunities. But I like the way the wording of this one was set, which is that unexploited profit opportunities will not exist for long, because I think anybody who's a logical person realizes that the markets are going to have opportunities, okay, uh, that are unexploited, but as they become recognized through the dissemination of information, people are going to act on them, and those unexploited opportunities become exploited for a period of time, and for some lucky few that are right on the beam and are acting on those, and then they're eliminated. They go away. Those opportunities are, exhausted essentially in the marketplace. So yeah, so that's another portion of the efficient market hypothesis and the general efficient market idea. Okay, then I did want to throw in something on random walks, so I threw in question number 25 to say that the stock prices that following a random walk is, what does that really mean? And saying the stock prices rise and then fall. Well, that's going to happen whether you believe in random walk theory or not. So A can't be right. B, stock prices rise and fall in a predictable fashion. No, that's something I just made up. Stock prices tend to follow trends. Well, that doesn't have anything to do with random walk. It might be the case, or it might be the case in some instances, or for some stocks in particular, they might follow trends, but that's not what random walk is all about. But if you get down to D and you see the stock prices are, for really all practical purposes, unpredictable, that's what random walk means. I mean, if you sit there and understand the definition of the word random, I mean that should pretty much give it away. But yeah, I mean that's why they named this thing random walk, is that your stock prices are unpredictable for the most part. If you believe in random walk, then you you're a proponent of the fact that stock prices are really unpredictable. So yeah, so D is the right answer there. Okay, I'm just gonna kind of I'm gonna wind this up here pretty soon, and we're going fairly slowly, but I've been talking my ear off. But the rest are just true and false, so let's just go through those really quickly. Stock tips from analysts are the types of information that most likely will enable exploitation. Well, we talked about that earlier. It's really more, if I would have said insider information, then that would be a true statement. But in this case, stock tips, that's no better than the technical analysis might have led that stockbroker to come up with that tip. And that's not necessarily going to be the case. So that's a false statement. So 26 is false. I know a few of you missed out on that one, but that's just the way it is. I mean, you might have some stock tips that might, enable investors to potentially exploit an opportunity, but there's no guarantee of that ever. And in most cases, you're probably not going to be able to exploit any situation based solely on stock tip. Okay, 27 rules used to predict movements in stock prices based on past performance are usually a waste of time, according to efficient markets. And that's true. They talk about how technical analysis, looking at all these movements in stock prices and analyzing the hell out of those is or can be a waste of time if you are operating under the 100% idea of efficient markets. So that's a true statement. And then conversely, right here on number 28, you kind of have that taken to a different level. You got technical analysis can often help in outperforming the overall market. Well, no, I mean, based on 27 being true, then 28 is false. There's no question about that. So technical analysis, as much of these stockbrokers and analysts like to try to, put themselves forward as being experts, there's really there's no track record of financial analysts consistently outperforming the market, no matter how much technical analysis they do. So that's false. My brother, who is a big technical analyst, might disagree, but I'm a fundamentalist and I say he's wrong. Okay, moving on to 29. We got bonds are a form of debt financing issued by investors. I worded that one specifically to generate error. Okay, bonds are a form of debt financing. That's true, but they're not issued by investors. They're issued by companies. Investors buy the bonds. Okay, investors are essentially lending money to companies that issue bonds. The companies issue the debt. They pay coupon payments, interest, and they make the face value payments at the end of the terms. But they're issued by companies, bonds. They're not issued by investors. So that was a trick question, kind of the way I worded it, and unfortunately, a few of you fell for it. But a lot of you did get it correct. So good job. But yeah, that's a false statement that the bonds are not issued by investors. They're issued by companies. Okay. 30. I was hoping everybody would get this right after 29 being a little trickier. For 30, junk bonds are also referred to as investment grade. Hardly. Junk bonds are what you might think they are. Junk bonds are not investment grade or high grade investment opportunities. They're risky, and they may potentially provide a nice return for you, but they're also usually quite risky of defaulting. So 30 definitely false. Junk bonds are not investment grade. AAA bonds, AA, B bonds, those are investment grades. Okay. Moving on to 31, we've got a false statement there, zero coupon bond. I just put that out there for the simple fact that I'm referring to zero coupon. So you see the word zero, you might think junk, you might think zero or little, but no, zero coupon bond. It's just a bond that doesn't pay any coupon payments. It doesn't have any higher or lower value depending on what the market value is telling us. A zero coupon is going to really depend on interest rate forecasts, and what interest rate movements might impact the investor over the period of time that they're holding that bond. Because once again, the zero coupon bond is not paying any coupon payments over the period. It's just going to make its face value payment at the end of the term. And the longer that term is, the better the interest rate better be for a an investor that's holding that, because they're not going to get those coupon payments over the interim period. 32, corporations commonly issue bonds to revise their financial structure. I think that's a statement right out of the text. That's true. Okay. If you're talking about weighted average cost of capital, as I was in my other course that some of you are part of, that I was talking about this morning, you've got debt and you've got equity that companies will be financing their operations through, and companies will typically issue more debt or bonds in order to revise their weighted average cost of capital or their financial structure. So that is definitely a true statement. Okay, moving on. We've got 33. Yeah, that's another statement right out of the text. I think I mentioned that you should just familiarize yourself with some of the market history. But yeah, during the financial crisis, when the housing bubble collapsed in 2007, 2009, we had the Great Recession, as a lot of people have now coined that period. The Dow Jones average fell to a low of near 6,600. That's a true statement right out of the text. 34, I wanted to give everyone an easy one. The Central Bank of the U.S. is certainly not the Bank of America. It's not Citibank. It's not, First National Bank on your corner hometown. It's the Federal Reserve Bank. So hopefully everybody got that one correct. I'm not looking at the results right now. I just want to get through these. Black Friday was the stock market's worst one-day drop. Nope. Black Monday, yeah. Black Friday, no. Black Friday is a great song by Steely Dan. I'll just leave it at that. 36, a bond mutual payment, future payments, I should say, are called as cash flows. Yep. That's just, that's a given, which makes sense. I mean, a bond that's making its coupon payments or its face value payment at the end of the term, those are cash flows to the investor. They're referred to as cash flows. 37, corporation suffers significant losses. The demand for its bonds will rise. Due to the higher interest rates the firm must pay. Boy, did I ever, that's not even a logical statement. I hope nobody got that one incorrect. But yeah, that's false. I mean, if a bond suffers significant losses, and it's demand for it is probably going to go down the drain, or at least really be hurt by the company's losses until the company can right itself and demonstrate that it can continue to operate profitably and not risk default, right? Because obviously, if you stop and think about it, a company that suffers significant losses might actually default, right, on its future payments, on its coupon payments. So that's the case there. 38, financial markets and institutions may affect the profits of businesses. I'd like to think that everybody got that one correct. It's a pretty straightforward statement that's true. The same thing with bonds. Investments are often referred to as equity securities. Nope. If I said stock investments are often referred to as equity securities, I'd be making a true statement there. But bond investments, bond are debt securities. So that's a false statement. The elimination of riskless profit opportunity in a market is called arbitrage. Yeah, because if you stop and think about it, companies or individuals will take advantage of profit opportunities through something that's also or often referred to as third party arbitrage. They take advantage of that profit opportunity until it's eventually eliminated or until it eventually dries up. So that's a true statement. Okay, taking advantage of a riskless opportunity until it's eliminated is indeed called arbitrage. Moving to 41, interest rate movements across countries tend to be positively correlated as a result of integrated international markets. Well, I think that's a logical statement that hopefully all of you saw as being true. And a lot of that makes sense, and especially in today's global economy where a lot of information is freely flowing across country borders. International markets are much more integrated than they were, even as recently as 10 or 15 years ago. But interest rates movements, obviously, in any country or any group of countries are really going to positively affect or are positively correlated to the financial results of international markets for the simple fact that there is integration in the markets. 42 is probably one of the dumbest statements I've ever put together for a test question. The yield curve is directly related to interest rates and term. To say it has no relationship to interest rates is a false statement beyond being false. It's just ridiculous and not even close to being true. So we'll move on. 43, continuing on with ideas on the yield curve. It's currently sloping upward. Long-term returns are greater than short-term returns. That's exactly what that means. Once again, you've got your interest rates on, the y-axis. You got term along the x. So as you move along the x-axis, and you've got, a gradually sloping line, that means that long-term rates are greater than short-term, which makes sense in a normal economy. I think that was one of the earlier questions. That's always going to be the case because you got to deal with potentially greater risk the longer you're holding securities. So you better have that higher interest rate. So yeah, definitely 43 is a true statement. 44, a situation in which the price of an asset differs from its fundamental market value is called a bubble. Yeah, that's just a definition right out of the text. So we're good there. Hopefully, a bubble is a situation when an asset price differs from a certain value, and which makes sense too. I mean, you get a bubble when you can take advantage of a market situation when it's different than what your fundamental value really is. You might be able to get on the ground floor of a good opportunity if an asset is selling for less than its fundamental value. And once again, that is called a bubble. Okay, moving on to 44, studies of mutual funds. Performance indicate the mutual funds that outperform the market in one time period will continue to do so. I reworded that question from a quiz question, I think, or a statement in a text anyway. I think the statement in the text was that if you have a mutual fund that outperforms in one period, then the next period it's likely to underperform. If I remember, it's a situation where, okay, well, you're really good in one term, but the next term watch out because it's hard to sustain that. So I kind of took that statement and ran with a different idea, which is, okay, well, if it if it outperformed in one period, it's going to keep doing so. Well, it may, but there's no guarantee of that. And they did make a statement in the text that it was, likely that anything that outperforms the market in one period is going to just turn around and underperform the next. So that's a false statement. It's a difficult statement too, because I mean, you might think that, hey, a mutual fund might be like a company. I mean, you might be outperforming the market and expectations, and continue to do so if the company is being run correctly. I mean, I think there's a lot of logic to potentially say that could be a true statement. It is right out of the text, and I did take that right out of the text for a reason, because it was a little bit of a difficult idea to totally, get your hands around or heads around, um, unless you just happen to remember that statement right out of the text, or we're able to go back and refer to it. Okay, moving on, 46, we got banks and other savings lending institutions have been adept at innovation, in the face of regulatory changes. Yeah, I think that's another statement right out of the text. So that's true. Um, and I guess I don't really have any further comment on that. It's just generally a true statement that banks have been pretty adept in adapting to changes in the regulatory environment. So yeah, definitely true. Um, 47 is now possibly the easiest question on the quiz or test. The yield curve is rarely monitored. Boy, that's a false statement if there ever was one. A lot of analysts really look and swear by the yield curve, especially, I mean, not just a general idea of a gradually upward sloping yield curve in normal economies. I think, um, you got to look at specific details and specific um, heightened analysis maybe of a shorter time period, as opposed to, looking at years and years and years. You might look at, just a few weeks or a few months on that horizontal axis, to understand what's going on with the rates that are depicted on the vertical axis of the yield curve. Okay, moving on to 48, we got just a time value of money problem. Interest rate of 10%. You got a present value of security is 1,100, paying next year, and then 1,460 4 years out. You got to just figure out, okay, well, what is the present value of that? When you run those numbers, you're going to come up with approximately $2,000. I think it's like 19 something, but it's real close to 2,000. So that's a true statement. I think that was right out of the text too, if I remember right. Here's one that I was disappointed that a few of you missed, but you gotta remember that I'm taking quiz questions, and in some cases I'm rewording them. Excuse me, to come up with a bit of a different potential answer. So in this case, you got 6%, and you got a present value of 100. What is that going to be if that money is received a year down the road? Well, it's not going to be $106, because if you're receiving the 100 a year from now, it's going to be worth less today, right? Because you're getting it in the future. So the time value of money is really going to make that worth like $94 or so. It's going to be less than the 100. Remember, the $100 received 1 year out is not really worth that same dollar for dollar value that it would be if you received that $100 today. So definitely a false statement. the $100 is going to be worth less if it's received 1 year from today, as opposed to being received today. Okay. And then finally, the last question, the interest rate that financial economists consider to be the most accurate measure is the yield to maturity. I think that's another statement that's directly out of the text, but yeah, I mean, the yield to maturity is literally the interest rate that's calculated in a time value of money problem or a bond valuation problem when you're given the other inputs to calculate that. But it is generally considered to be the most accurate of any interest rate information that's available out there, because you can come up with actual, hard calculated rates. Well, things like inflation rates and prime lending rates and things like that are usually estimates. Um, when you're calculating a yield of maturity, you're calculating an exact rate. So saying that it's the most accurate is another way of saying that it's an exact answer to a time value of money problem, and that's pretty much it. But yeah, that kind of winds things up for our midterm. I did want to go through all these in some detail, not only for the people that missed a few of these problems, or but just generally if you had any questions on them. And obviously, these are all important concepts that I want to make sure you're comfortable with and you're happy with, and that you would generally tend to get correct. Now, I will not be going over any of these problems again in the final. The final is going to be a different, our last half of the term, those chapters. So you won't encounter any of these questions again, but hopefully this was a good use of our time. And I'll just throw it open to you guys if you got any questions or got any comments, anything going on that you might want to talk about or bring to my attention. Everything good? Okay, I see everybody's kind of nodding their heads. Everything's good. So good. Generally everybody did fairly well on the midterm. I didn't see any failing grades. I saw a few that could use some potential improvement, and hopefully you'll accomplish that over the last half of the course with the assignments and with the final exam. But for the most part, most of you did very well, and I like to see that. So I can only hope that because you're doing well, that you're understanding the concepts and that you're comfortable with the assignments, and the quizzes are pretty much done with. But now you're beginning this week in chapter 6, we have like a homework assignment. You're going to have one this week, next week in chapter 7, week 7 rather, the following week in 8, 9, and then we have our final exam is in week 10, our last week together, and a shorter assignment that's just going to cover, I think, like one chapter on foreign exchange markets, if I remember correctly. But yeah, we'll cover all that in future sessions. If nobody has any additional questions or anything, I'll turn everybody loose. Everybody good? All right. Well, thanks again. Sorry for the
Thank you.
yeah, no, my pleasure. Sorry for the length of this session, but I did want to go through all this stuff in some detail, and I decided it makes sense to go through each of the 50 problems. So that's why we're here at 5 o'clock, an hour and a half. I could potentially go longer. I'm talked out. I can't talk anymore. I'm getting hoarse. I gotta stop and I gotta grab myself a beer or something like that. So have a great weekend, everybody. Thanks again, and we will talk to everybody on Monday, all right?
Sounds good. Thank you very much.
Thank you.
Thank you.
Okay,
you.
thanks, everybody.
Thank you.
Great job. Thanks. Bye-bye.